by the food component, which remains stubborn. While the fuel group remained in deflation, the expected moderation in headline inflation during the second quarter of 24-25, that is in the second quarter of the current financial year, on account of favorable base effects, is likely to reverse in the third quarter. This is something which I had also explained in the last monetary policy meeting in June, that in the third quarter we have a substantial advantage of the base effect, which may pull down the overall inflation numbers. But going forward, that base effect will wear out. Domestic growth, however, in these circumstances is holding up well on the back of steady urban consumption and improving rural consumption, coupled with strong investment demand. Amidst this confluence of factors, the MPC judged that it is important for monetary policy to stay the course while maintaining close vigil on the inflation trajectory and the risks thereof. Resilient and steady growth in GDP enables monetary policy to focus unambiguously on inflation. It must continue to be disinflationary and resolute in its commitment to aligning inflation to the target of 4% on a durable basis. Accordingly, the Monetary Policy Committee decided to keep the policy repo rate unchanged at 6.5% in this meeting. The commitment of monetary policy to ensure price stability would strengthen the foundations for a period of sustained growth. Now, this point needs to be appreciated, that ensuring price stability eventually results and supports a period of sustained growth. Without price stability, high growth cannot be sustained. So therefore, especially in a situation where our GDP growth is holding up well, we have decided to focus on inflation and ensure price stability, mainly to support growth. In these circumstances, the MPC reiterated the need to continue with the disinflationary stance of withdrawal of accommodation to ensure that inflation progressively aligns to the target while supporting growth. I would now like to provide an assessment of the growth and inflation conditions in India. But before that, let me briefly touch upon the global growth scenario. Global economic outlook exhibits steady, though uneven expansion. Manufacturing is indicating slowdown, while services activity is holding up. Notwithstanding sticky services prices, inflation is receding grudgingly across major economies. With varying outlook for growth and inflation across countries, monetary policy is showing signs of divergence across jurisdictions. Several central banks are cautiously moving towards policy pivots, though through forward guidance and rate cuts. While at the same time, there has been tightening by a few central banks also. So on the one hand, you have several central banks which are moving towards a rate cut scenario, but on the other hand, you have a few economies which are on a rate hike mode. Global financial markets are exhibiting volatility. Bond yields and the dollar index have softened since the last meeting of the MPC in June. While the near-term outlook looks positive, I'm talking about global growth. While the near-term outlook looks positive, there are significant challenges to medium-term global growth outlook. Demographic shifts, climate change, geopolitical tensions and fragmentations, rising public debt, and new technologies such as artificial intelligence pose new sets of challenges. A coherent policy approach in which monetary policy is complemented by other policies to manage the policy trade-offs will be crucial to deal with such multiple challenges. Let me now turn to domestic growth. Domestic economic activity continues to be resilient. On the supply side, steady progress in southwest monsoon, higher cumulative kharif sowing, and improving reservoir levels augur very well for the Kharif output. The likelihood of La Nina conditions developing during the second half of the monsoon season is likely to have a bearing on agricultural production in the current financial year. Manufacturing activity continues to gain ground on the back of improving domestic demand. The Index of Industrial Production, that is IIP, growth accelerated in May this year. Purchasing Managers Index, that is PMI for manufacturing, at 58.1 in July remained elevated. Services sector maintained buoyancy as evidenced by the available high-frequency indicators. Now, when I say high-frequency indicators, I have given a lot of details in the footnote of my statement, which, as you would know, will get uploaded immediately my statement is over. In fact, for almost, most of the statements which I am making, there is a lot of backup data which we have given in the footnotes. So in the interest of time, I am not reading out that data, but it is there in the footnote. So when the statement is uploaded, I would encourage you to please have a look at it. Similarly, PMI services stood strong at 60.3 in July and is above 60 for 7 consecutive months, indicating robust expansion of services. On the demand side, household consumption is supporting a turnaround in rural demand and steady discretionary spending in urban areas. Fixed investment activity remained buoyant amid government's continued thrust on capex and other policy support from the government. Private corporate investment is gaining steam on the back of expansion in bank credit. Merchandise exports expanded in June, although at a slower pace. Expansion in non-oil, non-gold imports accelerated, reflecting resilience in domestic demand. Services exports recorded double-digit growth in May this year before moderating in June. Looking ahead, improved agricultural activity brightens the prospects of rural consumption, while sustained buoyancy in services activity is expected to support urban consumption. The healthy balance sheets of banks and corporates, thrust on capex by the government, and visible signs of pickup in private investment would drive investment activity in the current year. Improving prospects of global trade are expected to aid external demand. In fact, so far as external demand and the improving volume of global trade is concerned, all the international agencies have projected, a good growth in global trade vis-a-vis the numbers that we saw last year, and the numbers are given in the footnote. The spillovers from protracted geopolitical tensions, volatility in international financial markets, and geoeconomic fragmentation, however, pose risks on the downside. Taking all these factors into consideration, real GDP growth for 2024-25, that is for the current year, is projected at 7.2%, with Q1 at 7.1%, Q2 at 7.2%, Q3 at 7.3%, and Q4 at 7.2%. Real GDP growth for Q1 25-26, and this is something which we are giving for the first time. Real GDP growth for Q1 of next financial year, that is 2025-26, is projected at 7.2%. The risks are evenly balanced. Now, it may be noticed that we have slightly moderated the growth projection for the first quarter of the current financial year in relation to the projection which we gave in the previous MPC in June. This is primarily due to updated information on certain high-frequency indicators which show lower than anticipated corporate profitability, central government, general government expenditure, and core industries output. Let me now turn to inflation. Headline inflation edged up to 5.1% in June 2024, due to higher than expected food inflation. Fuel remained